From Jamaica to the world, it's just love. It's just love. Why must I love anything? Everyone.
A nice little scene there of a Polestar car driving at the end. I'm sure you all saw that. But it's not the same one that's next door in the exhibition. So make sure you check that out. Thank you and welcome to Singapore for the inaugural Future Facing Commodities Conference. My name's Stuart McDonald and on behalf of Resource Connect Asia, I would like to say thank you for coming out today, early. I know Singapore doesn't do early very well, but we have to start early to get through the day. Some of you will know us from our events in Australia, like the RIU Explorers Conference and the RIU Sydney Resources Roundup. And you will know that we are very familiar with running events like this. So now we start looking internationally. So why not Singapore? And what's our reason for being here? We live in a changing world of rapid advances in technologies and increasing pressure to address climate change. So this means movement away from traditional energy sources to a more carbon-friendly environment. It's like an energy transition period. And that's what this conference is about. It's connecting mining and ESG, sustainability. Hence the name Future Facing Commodities, and hence the electric car in the exhibition. I made contact with Tribeca about 9 months ago to see if there was something we could do up here together, because Tribeca is the big global fund based up here. And we hatched a plan to run this event. And I'd like to thank from Tribeca, one of their partners in the capital, Scott Clements, Scott's been a powerhouse of help to me in running the event and to making sure that we get the right program and the right level of investor participation that'll come through the next 2 days. We formed a foundation sponsor, and Argonaut came on board. Now, Argonaut are the Australian stockbroking firm, and so Argonaut and Tribeca, you'll see them on your screen there. They are the foundation sponsors of this event. So to Scott and his team, to Eddie Rigg and his team, we also formed a project committee with Warwick, Hazeltine, and I guess this is where we are today. We're standing here now. The idea quickly spread once we got our database activated, and we had a lot more sponsors and companies and supporters getting on board. I'll just take you through a couple of those sponsors now, if I can. We have SRK, who were the drink sponsor for last night. We had the Mining Club function yesterday, which was outstanding. And they were the sponsor for the Mining Club drinks and for our welcome drinks. So thank you, SRK. Intertech Minerals, Global Assay Lab, they come on board. They were drink sponsor for tonight. So when you're having a drink tonight in the room next door in the exhibition, go and thank Intertech, because it's their money that pays for the drinks tonight. The Lind Partners out of New York, they sponsor a lot of our events. So thank you to Lind. We also have 2 other sponsors, Metz Engineering, who are the lanyard sponsor. Now, if you just have a quick look at your lanyard that's around your neck, you will see an Indigenous design that's sitting on that lanyard. That was designed by one of my team back in Perth. We have an Indigenous events company, and that nice chap designed this lanyard especially for this conference. It's his way of saying welcome. And of course, we have the on-site program sponsor, Excalibur. And the on-site program is available through your QR code on the app. If you haven't got an app, go to the front registration desk and you can see all about Excalibur. Many thanks to over 60 companies that have also been here. They come from Australia, Canada, Asia, UK and USA. Pretty good for a first up event, we think. An event that will obviously want to grow in time. Special thanks to a company from Canada called INN, Investor News Network. They're a Canadian agent, and they've brought down with them, I think, about 10 companies for the inaugural one, which is a very big effort, including the Inventor Group, which I see Liz here somewhere in the audience. So thank you to those companies for buying in, not knowing what this is, coming all the way from Canada to be here in Singapore. Also, I'd like to thank our keynote speakers. We've got Mr. Lithium on soon, Joe Lowry. You're all familiar with Joe, his global reputation as being one of the leaders in knowledge in the lithium industry. From BHP, we have Sonia Scarsese and she's talking about her Explore program, which is a very good thing for the junior companies. And then we have a special thanks to the Australian Federal Minister for Resources in Northern Australia, Madeleine King. She'll be giving a presentation also this morning. We thank the Minister and the Australian government for sending up the Minister, because it's the first time since COVID that a Minister has been in Singapore. So we're glad they chose our event to be. That's the importance that our government is placing on future-facing commodities. Thank you to the many delegates and investors for making the effort to be here today. And a special mention to the Singapore broking community and houses and funds and family offices for being here. They've bought into the vision, and hopefully over time, the amount of Singaporean investors that invest in stocks that are in these commodities throughout the world will increase. I'd like to thank SGX, the exchange, Phillip Capital, Saxo Capital, CGS, CIMB, Spark Plus, just to name a few, who have got on board and seen the vision. Our event is being live streamed today, so hello to the world. Hello to those that are here. Hopefully we get a good online participation and they can see what they're missing. So yesterday we had the Mining Club. That was a great success for those that were here. I hope you enjoyed that. And now I would just like to say, that's the end of my speech, and enough of me. I'll get off the stage, but I would like to introduce to you now our MC for the next 2 days. Her name is Christina Morrissey. She's standing over there. She'll take control from here. She's a wonderful MC and she'll keep you fully informed over the next 2 days. So best of luck with your investing. Best of luck with having your meetings. Best of luck with hopefully finding what you want out of this 2-day event. Thanks again to all the sponsors. Thanks again to my event partners. And last but not least, I want to thank my team and my staff it's been a big effort for running a show in Singapore from Australia. So on behalf of myself and my darling wife, who's Interlang Marketing, co-organiser, and I want to mention just a few names of my staff: Prue McFarlane, Jackson Crabb, who have been outstanding in getting this event off the ground. That's all for me. Thank you very much.
Thanks, Stu. Well, hello, everyone. Well, how great to be here for Future Facing Commodities, and wonderful to finally meet you all in person. I've really been looking forward to my role here with you all to introduce you to the companies, the people and the ideas that are contributing to our global energy transformation. And there's never been a better time for a conference like this. We've got companies, both public and private, they're collaborating with governments to decarbonise industry, to electrify industry, and to have this collaboration is really, really unique. We have public and private companies, we have governments, and of course we've got so many increases in government incentives around the world to find solutions to our energy problems. And that for us means more opportunities, more investment opportunities. We just need to find the right horse to back, and to do that, we need to do our own research. And this conference over the next 2 days is the perfect opportunity for you to do your research. So hello and welcome. My name is Christina, as Stuart said, and as you can guess from the accent, yes, I'm part of the Aussie crew that's come up here to put future-facing commodities to you. Now, I come from a little town called Kalgoorlie in Western Australia, and Kalgoorlie is home, or the heart, of the infamous Golden Mile and the Super Pit. And the Super Pit you may have heard of, it's been responsible for the odd 60 million ounces of gold. And explorers are now finding more and more of the future-facing commodities that we need to power the world. So it's a little town that you'll be hearing a lot more of, I'm sure, in the future. So let's have a look at what we need to know a little bit more about today. Let's go first for the app. So the app that I'm hoping that you all will have downloaded. If you haven't, it looks like this on the App Store. So download that, you'll see a complete map of the exhibition hall where everyone is located. You'll also see all the presenters, the times that they're up at. You'll note that we actually have 2 auditoriums. This one, Auditorium 1, where I will be. It's where we're starting and finishing the day. It's home to our keynote speakers, as Stu has pointed out. Also home to company presentations and a little thing that we call the fireside chats. Auditorium number 2, some really powerful company presentations and also some wonderful panel discussions, including one today about the global energy transition. And what we would like to encourage you to do is to move between the 2 auditoriums freely. So if you're in the middle of one presentation here and you think, right, I've heard what I need to from those people, I need to move across to auditorium 2, you do that. We do not mind you jumping up in between presentations or in the middle of a presentation and moving backwards and forwards. Do remember that our presentations are online. So if you need to go back and research anything, you can. But of course, the beauty of being here for the 1,300 of us that have registered is access to all our fantastic presenters one-on-one as the course of the conference goes on. Point number 2, while you've got your phones out and I've got your attention at the screen, we do have a conference Wi-Fi as well, and that's the password up there. So make sure you get involved in that one. Pop that one on your phone too. So we've got a massive program to get through over the next 2 days. So I think without any further ado, I'm going to move to the side and I'm going to introduce you all to our first speaker waiting in the wings. His name is John Stover. John, do you want to put your glass down and come on up here and join us? So many of you from Singapore will know John really well. And if you know Tribeca, you'll know him well as well. He, of course, is he's the portfolio manager for the Tribeca Asia Credit Strategy. And he's going to tell us today about his analysis of the super cycle investment opportunity here in Asia Pacific. Would you please make him very welcome, everyone?
Great, thanks very much. And thanks everyone for joining. It's great to be here. My name is John Stover. I'm a portfolio manager for Tribeca Investment Partners based here in Singapore. We are an active asset management firm with about $3 billion under management. We have strategies ranging from equities, credits, natural resources, and decarbonization. And we also have a corporate advisory business and a private wealth business. And many of the business heads and portfolio managers for those funds are with us in attendance at the conference here this week. So we look forward to connecting with many of you as the week goes on. We're extremely excited to be a part of this conference. I think this is happening. I first of all want to say thanks to the sponsors and the organizers, but I think this is happening at an incredibly exciting time for Singapore. I've been based here over 13 years, and I can truly say it's never been a more exciting time to be in Singapore. I think the sort of energy that we've gotten, it's really become the center of finance and investing in Asia over the past 6 months. I think it seems to be every day I meet someone at the condo pool or get connected with someone from a friend who's a part of a family office that's set up here, or part of a fund that's moved here from Hong Kong. So I think it's an incredibly exciting time to be here. And this conference is really at the center of, in the confluence of mining, decarbonization, investing, and this really exciting Asia supercycle story that I think you're going to hear more about in the coming days. So, part of our job as fund managers is to spot trends early and then to find the investment opportunities that are going to drive returns on the back of those funds. So what I'd like to do with this short talk is just to pick up on a few of the trends that we're seeing at the moment, and hopefully that's what helps set the stage for some of the exciting companies and themes you're going to hear for over the next couple of days. There we go. So first of all, decarbonization and ESG 1.0. This is obviously a theme that's been picked up a lot of steam in recent years. I'd say coming out of COVID, it was almost like a snowball rolling downhill. But I think, and certainly this is something that as investors we look for in companies, and we want companies to be a part of in terms of, obviously we want them to improve their environmental, social, governance scores and improve their decarbonization through their supply chains. But often we felt like this thematic was on shaky ground. And what I mean by that is it sort of became more important to create a story rather than creating a real business model with profits, or at least the potential to be profitable. Certainly we want the companies that we're invested to be focused on this, but if you look at it, it's sort of what it morphed into. It was this disturbing trend where story was ahead of profits, and often there was some very strong tech component to this, and little or no earnings. And rather than growth at a reasonable price, GRP could have been described as harm, hope at a ridiculous multiple. And what we've seen over the past 6 to 12 months is that the wind in the sails of a lot of these high-flying companies has come out, share prices have come down, and we think there's been a little bit of soul searching in the space actually in terms of what investors should be focused on if they want to be a part of this thematic. And at Tribeca, we've always taken a much different approach. So we look for companies with strong earnings at the bottom of the cost curve, or and are profitable, or at least the potential to be profitable. And we've always taken a really proactive boots on the ground approach. So this picture here this is yours truly at Morowali in Indonesia. Those are bags of MHP behind me, which is a feedstock into the lithium-ion battery value chain. This is another one of our portfolio managers, Todd Warren, underground at a mine in Montana. He's in attendance here today this week as well. And we take this really boots on the ground approach because we feel like the stories that we're hearing at the mine gate, the stories that we're hearing at the processing plant, the stories that we're hearing, from a company that's a part of the renewable chain these are going to going forward rather than someone sitting behind a computer and stories that are being spun by someone sitting behind a computer. So, we're very focused on the battery material space, mining technology, nuclear energy, hydrogen, renewable energy, et cetera. And we feel like the future alpha generation is going to be driven by these picks and shovels plays and the commodities that are going to drive decarbonization going forward. And increasingly, and this is very important, I think we're looking for companies that can reinvest their cash flows into decarbonization at strong rates of return. And I'll talk a little bit more about that later. And part of the reason we feel this way is this huge demand boom coming from electrification. If you look at electric vehicles, they use 6 times more battery minerals across copper, nickel, lithium, graphite, et cetera, than a conventional vehicle. Benchmark's done a study showing we're going to need 384 new mines across these commodities by 2035 to meet the demand. And at Tribeca, we think the demand for these commodities like lithium, nickel, graphite, et cetera, can rise by 20 to 40 times by 2050. So this is just this huge demand growth that the industry is really not prepared for. And this is all happening at the same time that mining capex is at multi-decade lows. So you can see this chart here on the right, mining capex per unit of mine production is at the lowest level in decades. And it's really been flat for about the past 5 to 6 years. And this is happening at the same time that shareholder returns in the forms of dividends and buybacks are at all-time highs. And if you look at what we need in various decarbonization and global warming scenarios relative to the plan and committed capex, it really pales in comparison. So, I think a really interesting analog to this is actually what happened in the 1990s. And if you take a step back and think about what was happening then, obviously you saw this really red hot internet sector where companies like pets.com were trading at multi-billion-dollar market caps with little or no earnings and no viable business model. And so that drove a lot of the investment into those into the tech sector, and that really came at the expense of mining. And obviously that sounds pretty familiar to what we've seen over the past few years, right? And then of course, in a few years later, you saw this huge commodity demand boom coming from China urbanization that really drove the super cycle for the mining industry in the 2000s and 2010s. And so, I think we see a similar scenario to what's been happening recently. Obviously, you've seen this really hot internet sector. A lot of the money has moved into that region, into that sector, and that's really coming at the expense of investment into the ground and into processing. And obviously, we have this coming demand boom from the electrification and EV boom that we think is actually going to be about 4 times the demand growth than what we saw from China urbanization. So, it's funny. I mean, I look back I see what teenagers are wearing on the street these days, and they're sort of wearing baggy jeans, and I think they're making some of the same fashion mistakes that my generation made in the 90s. So I think mining executives, we may end up seeing them looking back and making the same mistakes that their predecessors did in the 1990s as well, because this stuff is all cyclical. And you look at where we were in terms of, this is the commodity index versus S&P 500, where we were at the dot-com bubble in the late 90s. We're roughly around the same area, the level today in terms of that ratio. And so we think this sets up well for the sector, the mining sector going forward. And I think, the auto manufacturers have realized this, the EV manufacturers. I think they've realized that the scarcity is now moving into the upstream. We've seen deals by GM, Volkswagen, Ford, et cetera. We obviously saw Ford just announced they're going to participate in a $4.5 billion nickel processing plant in Indonesia. And, I think you see an executive like the director of purchasing for General Motors say, quote unquote, we're absolutely convinced that this is a race, a zero-sum game, and resources are a finite limit. That's pretty heavy stuff for one of the largest consumers of these commodities. And this has really picked up M&A in the resources sector broadly. We've seen several billionaires in Australia that are currently undergoing mining M&A at the moment. That's something we really haven't seen since the last China urbanization boom. You saw Glencore, they're looking to take over Teck Resources, obviously, very recently. So I think a lot of both strategics in the mining spaces and the EV producers have realized that the scarcity is actually moving to upstream. And I think the market started to pick up on that as well. So if you look at where the 10 largest EV producers and the 10 largest tech companies, their market caps are down 30 to 40% over the past year. And if you look at the top 10 largest battery mineral producers, roughly flat in a pretty tough equity market. And actually some of the smaller producers that you see here at the conference this week, some of them their share prices have gone up 200, 300, 400% in the past couple of years. So, despite the fact that commodity prices have come down in certain cases and share prices in certain cases, we think the strategic value has just increased, as evidenced by what you're seeing in terms of all these deals with the EV producers and a lot of strategic M&A. And we think that's going to bode well for share prices going forward. And another one of the shifts that we see is we think Asia Pacific is going to drive decarbonization going forward. And, I think, let's face it, I think US and European companies and countries really have been the initial drivers of decarbonization. But you look at Asia, Asia has the highest amount of carbon emissions, but that also means it has the greatest opportunities to decarbonize and the greatest low-hanging fruit. And we think Asia Pacific is going to provide investors the best opportunities to invest in decarbonization at strong rates of return going forward. And we're already starting to see that. So Asia is already a leader in wind capacity additions and solar capacity additions and battery storage installations. And we think there's going to be a lot of really interesting investment opportunities to invest in companies that have opportunities to decarbonize at good rates of return. And look, I think decarbonization is going to be one of the biggest human undertakings we've ever seen. Certainly economically, the biggest we've seen since the Industrial Revolution. And Asia Pacific is going to be the bulk of that spend. So under 2050 net zero scenario, there's going to be about $9 trillion of annual spend. And Asia is going to have about $3.5 trillion of that. And on the corporate side, it's interesting. Over the last several years, I think one of the issues in the corporate world is that I think as investors, we've certainly been guilty of pushing management at companies too hard to produce shareholder returns in the forms of dividends and buybacks, which of course we love that as investors, but that's really come at the expense of CapEx and R&D. And Asia Pacific corporates have actually shown a much greater willingness to reinvest their cash flows in CapEx and R&D. And what's interesting is that the market's actually starting to reward that. So Goldman Sachs has done a study that shows reinvestors in decarbonization have started to outperform their peers significantly. So we think Asia Pacific corporates, again, are going to provide the most interesting opportunities to reinvest their cash flows into decarbonization. And that's what we're looking for increasingly as investors, because this provides this sort of virtuous cycle where there's compounding earnings and decarbonization that is incredibly attractive to investors. And I think if you look at if you look at Asia Pacific, and I think one of the other themes we've seen over the past few years is some of our global institutional investing peers, they've taken a divestment approach and divested certain companies that are have emissions. And I think at Tribeca, we think a much more nuanced and intelligent approach is warranted. It's not realistic to think that we can go to net zero overnight. So we need to be willing to finance these companies to take the transitionary steps to a net zero world, rather than divesting completely. And I think Asia Pacific certainly has been more, investors in this region have certainly been more willing to do that. You see something like green bond financing, which Asia has become a leader in. Green bond financing in Asia was roughly flat last year when it was down significantly in other regions. And we certainly think green bond frameworks need a lot more work, but that they are improving, and we think that will continue to happen. And Singapore has really been at the forefront of this shift. And so with this divestment approach, we've seen a lot of our global institutional peers, they've lumped in the natural resources space with fossil fuel producers broadly and just, again, taken a divestment approach. But a lot of these natural resource producers, they're producing minerals that are critical to the decarbonization. So they're producing something that's going into a battery, or producing uranium that's going into nuclear energy that's going to help decarbonize the grid. So we need to be willing to finance these companies that are producing the building blocks of decarbonization. And obviously, we know Asia Pacific has a huge abundance of these upstream minerals. They also form the bulk of this processing. So again, we feel like the region is set up really well for investors to look at if they want to be involved in the decarbonization thematic. And these big changes can happen quickly. I mean, I look at something like what's happened in Indonesia with the downstream build out of nickel and cobalt chains. And I've really, having been invested in the region for over 15 years, I've never seen something at the speed and scale of what's happened there. So I think these big changes can happen quickly, and they're really going to drive trade flows. They're going to drive geopolitical power, and they're going to drive investing returns going forward. It's obviously not easy to pick the winners, but that's a part of the reason why we want to be a part of this conference, is to be at the forefront of this thematic. And we'd love to connect with any corporates and investors over the next couple of days to see if we can be helpful. So With that, thank you very much. Hope you look forward to the next couple of days. We try to cherry pick some of the companies and themes we think are most exciting, and hope you enjoy it over the next couple of days. Thanks very much.
Thank you very much, John. Right, it's time for our first keynote, the focus of which is going to be lithium. So for many of us, our lithium knowledge is quite small. We know about its use in batteries, and we know about its use in powering the future for appetite for power. One of the interesting facts you may or may not know about this element, it's actually only 0.002% of the Earth's crust. 0.002% of the Earth's crust, but it's playing a huge part in powering the future of our rapidly decarbonising world, and it was a natural choice for us as our keynote speech. So lithium had a whole other life before it started being used as batteries, and it has numerous other applications now. There is one person whose knowledge in this mineral is kind of like a walking Google, a walking Wikipedia, and it's even better than that because he has got real lived exposure to this particular mineral. In fact, Joe Lowry, you became hooked on this little mineral, didn't you, back in the 90s? It even brought you here to Singapore back in 1995. There were some of the early adopters of lithium, of using lithium in different applications. So to present our keynote for Singapore 2023, to give his insights into what's powering the world's appetite for the lightest mineral on the planet, would you please put your hands together and make welcome Mr. Lithium, Joe Lowry.
She got paid to talk nice about me, so I want to thank Tribeca and Scott for extending the invitation for me to speak here today. It's a big honor. Normally, I speak at lithium events around the world. This is a much more diverse audience than what I'm used to. So I am not gonna come up here for 40 minutes and read slides. I am gonna tell you a few stories. I do have slides, but I think the value here is because there's an audience that's not that familiar with the lithium industry, just to hit some high points and see where it goes. This does not seem to be moving my slides. Oh, there we go. Oops. Let's go back. So why do I call this the lithium decade? It's kind of a grand term to use. The reason I call this the lithium decade is simply because what's been referenced already this morning, that e-mobility has finally arrived. You can see the energy transition is here. You're seeing now, after false starts in the past that I'll talk a little bit about, that e-mobility is happening, it's gonna happen, but the lithium industry is not at all prepared to power the transition that's gonna come in the next decades. And why is the lithium industry not prepared? Because the lithium industry is a real tiny industry. When I started in 1990, it was a $200 million global industry. It took 25 years for it to reach $1 billion global sales of lithium chemicals. Since 2015, when it hit $1 billion, it'll be about 40 to 45 billion this year. But if you were in the lithium industry back in 2010, when Carlos Ghosn at Nissan said, I'm going to have 1.5 net zero vehicles on the road by 2016. The lithium industry was like, maybe that'll happen, maybe it won't happen. In January of 2011, then US President Barack Obama told the world that he was going to get 1 million plug-in vehicles on the road by 2015. That didn't happen. If you were one of the lithium producers, you weren't going to go build capacity for this idea that EVs were going to take over the world. It just simply wasn't a good idea in the mind of lithium producers. And if we frame the lithium world, in 2018, the top 4 lithium producers had 72% of the lithium supply. So it's a very, very small, concentrated industry. And nobody wanted to be the guy who put the capital in that drove the price down. So now we're in a situation where finally things are happening. And we've seen a run up in lithium price, and I'll show you some numbers later, but the price has gone up from spot price in China was under $4,000 in 2020. It hit 80,000 a ton last year, simply because just a move to 5% EV penetration tipped the market. And on the OEM side, when Tesla announced the Gigafactory in 2014, a few months later, I had a call with the people that were in charge of getting that built. And I asked them, do you have any idea where the lithium comes from? Not a clue. The Tesla, when they first started, were buying Panasonic 18650 cells. They didn't think about lithium, but then they announced that they were going to make a 35 gigawatt hour battery factory in Sparks, Nevada. And I said to the person who was leading the project, you're going to need 28,000 tons of lithium hydroxide if you actually do get 35 gigawatt hours. The big three lithium companies at the time had 18,000 tons of capacity. Only 8,500 tons of that 18,000 tons was qualified by Tesla's cathode producer, who they didn't know because Panasonic was sourcing the cathode. It was Sumitomo Metal Mining, had a plant in Shikoku Island, Japan. I had been the original supplier to Sumitomo Metal Mining when I worked for FMC Lithium, which is now called Lyman. So the great conundrum was, okay, if you've got a lithium industry that's not prepared to supply this first gigafactory, what do you do about it? And that was the question that I was asking. I said, you told us the problem, there isn't enough lithium. How do we solve it? And I said, you go to China. You have to go to China. I said, the US lithium producers, or the Western world lithium producers, are totally focused on NPV. They are not gonna bet ahead of demand. The Chinese will. And if you go look at the Chinese export statistics, about 6 months after I made that statement to Tesla did go with Panasonic to Japan or to China. They qualified several Chinese converters. And that's one of the reasons why, like in so many other commodities, that China took the lead. They were willing to invest. And now we're in a situation where lithium's going to grow tenfold at least in this decade. You can't really look at many other products where that's happened. And you can build a gigafactory in 2 years, and I'll show you a map of what North America is planning and what Europe's planning. It takes about 10 years to bring a greenfield brine project online. So there's a mismatch, and we're just going to have to live through that situation going forward. So lithium's unprepared for the ascendancy that they have. The other point that I would make to you, why I think lithium is so critical now, is everything in this energy transition is predicated right now on lithium ion technology. You can make a lithium ion battery with or without nickel. You can make it with or without cobalt, but you can't make a lithium ion battery without lithium. But my button's not working here, sorry. All right, major trends. What are the kind of things I'm looking at as this industry tries to get through the decade, tries to catch up with supply, tries to catch up with demand? What we've seen really since COVID started, it was a shock, I think, to all of us that the EV revolution really took traction in the first year of COVID, where it wasn't just China and Tesla. The Europeans started buying EVs in mass quantities. And we saw the situation where China had been, it was a total buyer's market in lithium. Lithium prices were extremely low. And then once we went up to around 5% EV penetration, the market flipped. The power dynamic completely switched from China to Australia, in my mind. That's the way I view it. And I know there's people who are gonna agree with me on some counts and disagree with me on other counts. But right now is, I think it's Chris Ellison likes to say it, you know, the guy with the rock wins. And we're seeing that play out. And that's a trend you're gonna have to keep watching, because it's gonna have major ESG impacts, because right now the Chinese are being forced to get the lithium that they need to go to Africa, to start taking direct shipped ore, to develop their low quality lepidolite. And that's gonna have severe ramifications. People, especially the European Union, likes to talk about implementing battery passports. And there's a lot of talk about how we're not going to accept, big automakers are saying, we're not going to accept materials from mines that aren't compliant and aren't making steps towards minimizing their footprint. And the biggest battery producer in the world, CATL, is out there mining low quality lepidolite, which has significant ESG ramifications. The other thing that we've seen, I think the speaker before me referenced it, is after Tesla started to realize that they didn't know where lithium came from, it would be a good idea if they found out. A couple years later, I was talking to the German automakers and trying to convince them that they were going to have to enable investment in lithium. They didn't have to invest in mines. I never suggested that. I suggested they gave junior miners, especially, bankable offtake agreements or prepayments or any number of different ways to ensure that capacity got built. And they didn't like that idea. They just said, hey, look, the battery guys are the guys with the lithium problem. We don't have a lithium problem. But this is back when they were just announcing building EVs. They found out a few years later, and we already had the reference about VW investing and GM investing in Lithium Americas. That's a theme I think you need to keep watching, because I think now everybody knows they have a lithium problem. And we've seen this year, in the beginning of the year, kind of extreme volatility in the China spot market. What's that all about? Well, I think you're going to see volatility in the lithium space going forward. I believe, honestly, that China's tried to create a false narrative to talk the lithium price down. I think in activity of some of the things CATL said and done. I think BYD's kind of on the same ilk that way. It's gonna be interesting, but I will show you the way I look at the numbers. We're in a shortage for the rest of this decade. And even though there may be mismatches between supply and demand and price might get volatile, the long-term lithium price is going to tend towards high, not low. So what questions should you be pondering if you develop an interest in lithium? There's a lot of talk now about regional supply chains. And quite honestly, as an American, I love what we're trying to do and saying we're going to build a robust battery supply chain in North America, because now politically, the US essentially considers Canada the 51st state in terms of critical minerals, and Canadians don't like to hear that much, but that is in fact how that's playing out. And one of the things about coming here to speak, this is called a commodity event. Lithium is not a commodity, it's a specialty chemical. People don't like to hear that. Lithium is a chemical industry that may or may not have a mining component. I think you need to think that way about lithium. But I totally agree that lithium is still going to be impacted by high prices. Ultimately are going to fix high prices. The question is when. And a lot of the bank analysts that look at this industry read definitive feasibility studies and just put it in their spreadsheet. And the dirty little secret of the lithium industry is there has never been a lithium project on time. It's just a question of how late it's going to be. So I'd be thinking about that. I'd be thinking about, will lithium become a commodity? I don't know. The only guys who can make lithium a commodity are the battery people. They would have to agree on a common spec. And that is not happening. And I don't believe it'll happen in this decade. It may happen later on. I referenced ESG earlier. I am not one of those anti-ESG guys at all. But the honest truth is that what people don't like to hear, and especially I see this in my country, that the Biden administration wants 50% of the cars to be EVs by 2030, but nobody wants mining. And a lot of the millennials that are protesting mining, they're doing it on an iPhone. And all an iPhone is a collection of mine materials. So we'll see how the ESG thing plays out. America's going to have mining. When I show you the map of the gigafactories here in a couple minutes, when you look at that map, there's a lot of battery capacity that's going to be built, especially after the Inflation Reduction Act was passed. Financing is going to be there. The problem is there is one permitted greenfield lithium project in North America. And GM's already claimed 100% of that output. But it takes that entire mine to run one of those big gigafactories if they're over 40,000 gigawatt or 40 gigawatt hours a year. We have one mine and it'll take 4 years to build that mine. So when North America and the EU talk about we're going to build a China-free, robust battery supply chain, that's not going to happen quickly. So what's the lithium market look like? Well, when I started in the industry, there wasn't a lithium-ion battery. So these pie charts looked a lot different when I started. First time I came to Singapore was 1995, and there was actually a fairly significant lithium market here. It was grease, it was engineered plastics, and it was pharmaceuticals. And now, in 2022, roughly 80% of lithium demand is all tied up in battery. And by the time we get to 2025, it'll be 90-ish. And by 2030, nobody will be showing pie charts anymore about lithium demand, because it's just going to be lithium demand is totally predicated on what happens in battery. So when we look at battery, what are the components of that from a lithium perspective? Last year, there were about 672 gigawatt hours produced, and 490 of that was for EVs. EVs are growing at, you can pick your compound growth rate. There's all sorts of numbers out there, but it's growing faster than it can be supplied currently by the lithium industry. Energy storage systems, though, are actually growing at a faster rate than EVs. And these numbers are from Supply Chain Insights, which is similar to what Benchmark does. And there's some debate about what the actual numbers were last year, but they're all kind of cycle around 700 gigawatt hours. And as we go forward, portables will grow at GDP rates or a little more than GDP, but EVs and energy storage for renewables are going to grow at either teens or near 20x. The whole point of this slide is where you see the green arrow. This was the tipping point. In the fourth quarter of 2020, lithium price started to rise. And that was on the back of a move just over 5% global EV penetration. These numbers are from Row Motion, who's one of my trusted sources for battery information. They have three cases here. The yellow line, the base case, shows 41% EV penetration in 2030. Yet when we went from 3% EV penetration to 5%, the lithium market tilted. So again, supporting the fact that lithium's not quite ready for prime time yet. I look at a lot of analyst studies of what's going to happen in the market going forward. People like to have these massive spreadsheets that project every possible EV model coming online, what battery it'll have, and if you want to project demand that way, that's perfectly fine. But there's quite an easier way to do it, and if you look at the gigawatt hours that are going to be produced in a year, and there are sources out there that'll tell you within pretty good range. All you have to do to project lithium is take that, multiply it by roughly 0.8. People will debate a little bit about lithium intensity, but if we look at last year, these numbers tie out pretty well with what happened in terms of lithium demand. These are McKinsey numbers for 2030. 4.7 terawatt hours. That's a big number. And when Albemarle, largest lithium company in the world, forecasted lithium demand in 2030, they moved it up to 3.7 million. And we'll talk a little bit about what that means in a second. These are my numbers. And a lot of people say that I'm just a perpetual lithium bull, but my numbers are quite tepid compared to Albemarle's and looking at it from the demand side. The important thing here is the red part of the line, or the bar rather, and the green part are the two chemicals that are used in batteries, lithium carbonate and lithium hydroxide. That's where all the growth is. But if you look at my numbers, the market stays just short of being in balance. I don't project a huge shortage, but I project a continual shortage. Albemarle has just come out with new numbers, and they predict in 2025 that we're going to need 1.8 million tons of lithium carbonate equivalent. That's a huge gap to what I show. And my supply line, that's pretty far north of my supply line. So what does that mean? If we frame Albemarle's numbers in terms of what it's going to take from a project perspective to meet that demand, 1.8 million tons in 2025 would be 1.1 million tons than the market would produce last year. That would take 25 rather, world-class brine projects to come online in 3 years. I promise you that is not going to happen. If you want to frame it from Western Australia mining, that would be the equivalent of 6 Greenbushes, 2022 production. That would be the equivalent of 13 times what Pilbara thinks they're going to do this year. There are a lot of new lithium projects out there, but from an execution perspective, you are not going to see a response that meets that kind of demand. This is Bank of Montreal. I just like to show multiple numbers just to show everybody in the term of demand and growth is speaking out of a similar songbook. And Bank of Montreal is a little closer to my numbers than Albemarle's, but it's still significant growth. So there are people out there that believe that China's going to mine lepidolite to a level where the industry is going to go to oversupply relatively quickly. I don't subscribe to that. Goldman Sachs does. And so when I take the cross-section of 4 banks and what they say about undersupply or oversupply, Goldman Sachs has a significant oversupply in 2025. The other banks I mentioned here, Canaccord, JP Morgan, UBS, they all have the market not too far out of balance, but all tending to undersupply. it's fascinating to me that when we talk about price, the banks that say the market's going to be undersupplied have price crashing. I'm not an economist, but when I look at this market, the lithium market's totally disconnected from the cost curve. And I think it's going to remain so. I don't know. I'm not going to, I have price numbers, but all I know when I predict the price is I'm wrong. I just hope I'm not too far wrong. Let's go back to the China story. When people talk about the lithium ion battery space, they talk about China's dominance. And that's a fair point, because China, if you look at the whole supply chain, and these are numbers from Benchmark. Last year, 70% of world cell production, 78% of the lithium active material that goes into the battery, 44% of conversion of lithium chemicals. And it's probably fair to point out, if you're not really familiar with the two types of lithium that are in the market, hard rock-based spodumene, right now in Western Australia, for the most part, a precursor is made, it's shipped to China, and conversion capacity turns it into lithium chemicals. So China has 44% of the lithium in the world that it's turned into chemicals, but they only have 13% of the raw material to make those chemicals. That's an important point as we get into the geopolitics, because that's an unsustainable situation for China, because what's happening now in Western Australia is the people with the rock are deciding they want to do the conversion in Western Australia. You have actually a Chinese company, Tianqi, in Kwinana. You have Albemarle with Minres bringing on a converter, and you have West Farmers and SQM. So that means the growth of supply from Western Australia, to a large extent, is going to stay home, which puts China in a much more difficult position from a lithium raw material perspective. And as well, now there's global competition for this raw material. Last year, 96% of Western Australia's lithium precursor went to China. But now conversion plants are going to be built in the United States, in Canada, and in Europe. So there's going to be a competition for the rock. If you want to build a robust battery supply chain, if you're the United States or if you're the EU, policies matter. And we've seen with the curiously named Inflation Reduction Act that was passed in August of 2022, that all these things have been announced on here, whether it's Tesla with a new Gigafactory, or it's Ford and CATL, BMW, Redwood Materials. The beginnings of this battery supply chain are happening. The curious point of this is, though, building gigafactories in America with no raw materials doesn't make a lot of sense. So it's going to be interesting to see how this plays out. Right now, I think the thinking in Washington is, yeah, we need to change our permitting rules. We need to change some things, but we also need to make really good friends with Canada, because they have more assets in the critical metals than we do. So here's the map that I referenced earlier. These are all the planned, or actually they're probably not all, and there's probably been some additions since I did this slide a few months ago, but this is a massive build out of battery capacity that's going to happen in America. And it's largely because of the Inflation Reduction Act and use of the Defense Production Act. This is happening. Yet, if we just take the Panasonic plant in Kansas that's being built, that would use 100% of the planned lithium capacity that's being built. The previously referenced Thacker Pass that Lithium America has, that GM's invested in. So this is not a good situation. This is Europe. And I did a tour of Australia in November and talked with a lot of the people that are in this room that are in the lithium business. And the way it was phrased by a gentleman who's actually sitting in this room, who I won't mention, he says, Europe's actually more screwed than North America is from a supply standpoint because they have less in the way of lithium assets. The lithium that Europe does have is complicated. If you're going to try to build geothermal and then use direct lithium extraction, right now, I don't know how many of you have heard of what direct lithium extraction, but there's a lot of talk about it. I'm actually on the board of a DLE startup, so I'm not anti-direct lithium extraction, but there is currently no commercial direct lithium extraction operating anywhere. My former employer uses a hybrid in Argentina and has since the 90s, but true direct lithium extraction is probably still 4 or 5 years away on a commercial scale. So people that talk about technology breakthroughs changing the supply demand balance, I don't think DLE is going to do it in the next few years. It will contribute long term. But the other thing, when people talk to you about direct lithium extraction, it's a bespoke technology. It's not drop-in. Just because direct lithium extraction works on one lithium asset, it doesn't necessarily work on the brine next door if the brine has different impurity characteristics. So where is the lithium going to come from ultimately? And the way I frame it is it's the usual suspects. And Australia are the heroes of the lithium industry, because if you go back to January of 2016, there was one operating mine, which was Greenbushes. And within a couple of years, you had these other operations, whether it's Mount Marion, Pilgangoora, Wojan is back in startup, Core will start up, I guess it's in startup right now. Mount Catlin, we got Anthony and Iggy Jan here in the building, who are familiar with that. And if this hadn't happened, we wouldn't have even started the EV growth, because unfortunately, if you go back 15 years, the industry believed hard rock was dead. Who would do a hard rock mine? Brine was much lower cost, SQM, Albemarle in Chile, Livent in Argentina. And the framing of this was always Greenbushes is the best asset and it will continue to run, but only because the Chinese will buy the material. And what happened when the industry was in dire need of supply? The Aussies bailed us out. If you look at 2025, there's a lot more happening in Australia. And one of the questions I ask everybody in the Australian lithium industry these days is, what is peak lithium supply coming out of Australia? Last year, about 300,000 tons of LCE were exported. This year, it'll be about 400,000 tons. But where does that end? Because if you believe Albemarle's number of 3.7 million tons of demand in 2030, that we need a lot more coming out of Australia. We need a lot more coming out of South America. I have a podcast. I had Chris Reed, who started Neo Metals, which is the Mount Marion project, had him on my podcast, asked him the question. He said he thinks that Australia ultimately can do about 1.5 million tons of lithium carbonate equivalent. I don't know whether that number's right or wrong, but I do know if that number's right, it's kind of a dire situation in terms of meeting the growing lithium demand, because we'll look at South America in a minute. This is kind of like this. The dominance of brine was very slow moving. When the lithium industry was very small, just the Atacama was enough. Just the Chilean Atacama, SQM operating on one side of the Salar, Albemarle on the other. And for 20 years, that was kind of the balance. My former employer, Livent, had an operation in Argentina, but it was 20,000 tons. It was 22,000 tons when I left the company in 2012. it was 22,000 tons last year. So not much was happening on the brine side. This year, we're gonna have Minera XR startup, that's a Gangfen and Lithium Americas joint venture. But that's really the first new project since Allchem started up Orocobre in 2015. So the brine part of the industry just didn't have the vision and didn't make the investments. And if SQM hadn't been able to triple their capacity over the last few years, it would have been a significant detriment going forward. I love this slide because it's great ambition. But if you look at the record of execution of projects, this is what the lithium triangle, which is, it's unique that people continue to talk about the lithium triangle, because the lithium triangle means this area with Bolivia in the north, Chile, and Argentina. But Bolivia has been trying to produce lithium from the Uni for 4 decades. And they've, I don't know, made maybe 15,000 tons in those 4 decades. So they're not a significant contributor. But all these projects that are on here, if they all come true, the market will still be short. But if they don't come true, the market will be very short. And my estimation is, of some of the new projects that are being built out now, probably half of them will actually be operating, not this whole map. To do justice to some of the other operating provinces, Brazil is going to start producing this year, or they've actually had minor production for decades, but they're going to be much more significant. And then probably Africa has a lot of activity going on, but I don't believe it's going to happen quickly. And then there's Canada. There is a lot of lithium in Canada, and there are a lot of projects in Canada. And I believe, I frame it this way: Canada wants to become the Australia of North America. And I hope they do. But Quebec likes to tout their great educated workforce and their low hydro cost. Quebec's been trying to produce lithium for the last 15 years. And only this year will they reopen a mine, and it's going to be relatively small. So Canada has a lot of promise, but they've really yet to deliver. The old Val-d'Or mine is starting up with Sayona as we speak, but that's a fairly small operation. Canaccord frames lithium projects. I love this slide because it just shows every lithium project's late. There was a FT article this week that basically framed it the way Canaccord says now, on average, lithium projects are 3 years late on average. I think it's a little worse than that, but you get the point. And if I didn't talk about price, people would be unhappy. So I will talk about price. Are we in a bubble or a new normal? I don't like $80,000 a ton lithium. Nobody saw that coming. I certainly didn't. I never thought it would go over 35,000 or 40,000 a ton. Yet last year we had it. How long will it stay high? How long will lithium be disconnected from the cost curve? Here's what some people think. Well, let me show you the benchmark slide. This is just the pattern since 2020. You see the huge rise. You see the steep drop in the China spot price. But the dirty little secret that Bloomberg and Reuters aren't going to tell you is that in 2023, the average price of lithium chemicals globally will be substantially higher than it was in 2022. It's not the spot price where most of the volume is moving, it's contract price, and contract prices are on formulas. In 2022, there were contracts selling at less than $10,000 a ton. Those will come off. They're gradually rising. If you look at the import statistics from Japan, Chinese material was still moving into Japan in February at over 80,000. So when you read this, the sky is falling because the China spot price is low. There's almost no volume moving at those prices right now. So how low it goes, I have no idea, but even with the steep drop, the lithium spot price is still 10 times higher than it was in 2022 when Orocobre, which is now Allchem, was selling at below 3,500. Spodumene. This is actually the most important number if you want to look at where price is going, because the cost curve is set by the converter cost curve. If the converters have to pay 5,000 a ton, which is probably still the number, I don't know where it goes this year for sure, but multiply that number by 8, because it takes roughly 8 units of 6% spodumene to make a ton of lithium chemicals, and then add the conversion cost. So then you got a $45,000 price if spodumene stays at these levels. I'm running out of time, and I know she doesn't take lateness lightly, so I'm just gonna go to here's what the big banks are saying about lithium price, but 4 out of these 5 big banks say it's gonna be undersupplied, but price is gonna crash. And this is my slide, which the green and the red areas are the cost curve if spodumene stays in the $3,400 range. And this is the cost curve if you have low quality lepidolite and spodumene. The converters are paying $1,900 for spodumene. So vertically integrated lepidolite actually becomes the price umbrella. And I will close with this. This is Morgan Stanley. And if you listen to my podcast, Morgan Stanley is kind of my global whipping boy, because they just come out with some bizarre numbers. And they predict a 500,000 ton shortage of lithium in 2030. They predict $1,100 spodumene, but they have carbonate at 8,300. If you do the math on those numbers, it makes absolutely no sense in any universe. That's all I got.
Thanks so much, Joe. A really big part of this conference over the next few days is not just giving you investment opportunities, but it's giving you knowledge to base your investment cast as well. And Joe, that was a brilliant way to start off today. And also thanks to John as well for building our knowledge base. Now, some of the investment opportunities that you are going to hear from today, in fact, a large percentage of them are Australian. And even those contributing to our fireside chats, our Aussies, we've got a really rich concentration, as we just saw from some of those slides that Joe popped up, of the elements needed to power our supply chain of the future. The Australian government is committed to all aspects of the supply chain, and I'd like to ask you all please to welcome Australia's Minister for Resources and also Northern Australia, Madeleine King.
Oh, good morning, everyone, and thanks, Chrissy. I understand you're a Kalgoorlie girl, is that right? So a great history in Kalgoorlie of where Western Australia mining really took off from the first time. And I know one of the organisers also from Kalgoorlie originally, because my grandmother's from Coolgardie. So we ties are deep to the gold rush of Western Australia from the 1890s. So thanks everyone for being here today, and thanks for the organisers of the event for the invitation to speak. It's my first visit to Singapore outside of Changi Airport as the Minister for Resources of the Commonwealth of Australia. And it's really my great pleasure to be here in Singapore today. And I'm really delighted to be in front of an audience that includes such a vibrant mix of miners, leaders, investors, governments, innovators, and suppliers. I want to thank the previous speaker, Joe Laurie, and I did not hear the start of his presentation, but I did see about the last 10 minutes. And what I took from that is it looks like the best place to invest is Western Australia, right? Like it looks, I think we're onto this now. So please come and visit and bring your capital with you. But he also, Joe did frame the challenges and opportunities ahead of the whole world, quite frankly, in the critical minerals and rare earths area. And as he said, The competition for the rock is really very real. I really like that phrase. It's a competitive world. It's our next resources economy, certainly for Australia and particularly for Western Australia. I acknowledge the next speaker is Alex Dorsch from Chalice Mining. It's a very exciting discovery there north of Perth, the Julimar project. And for those of you who don't know it, and I'm sure he'll speak about it, of course, in much more detail, the Gonaville deposit was discovered just 3 years ago. It was one of the largest undeveloped nickel discoveries worldwide in the past 20 years, but really importantly, the largest ever platinum group element discovery in Australia ever. And that's going to be a very important part of our future in critical minerals and rare earth elements. So conference like this, the inaugural future facing commodities forum brings together a lot of people to discuss the world's growing demand for the minerals we need to prevent a global and dangerous climate change. I want to congratulate the organisers, Stuart McDonald and Gloria Zhang from Vertical Events. It's a fantastic event and great to be here in Singapore, which is, as we know, a really principal investment hub and financial hub for a very important region in the world. Trade and business ties between Australia and Singapore are extremely robust. Singapore is Australia's largest trade and investment partner in Southeast Asia and our 5th largest two-way goods and services trading partner overall. And from a resources perspective, Australia's relationship with Singapore is crucial. As you are all no doubt aware, the resources sector is at the heart of the Australian economy, and we wouldn't be the nation we are today without the resources industry. And in my home state of Western Australia, that industry is part of nearly everybody's lives. 9 of the world's top 50 mineral projects are now based in WA, including 6 of the world's 10 highest value projects. As we know, and I referred to earlier in relation to Kalgoorlie, Perth was put on the map by the gold rush of the 1890s, but it was the opening of the iron ore trade from the 50s that transformed WA, and it was the LNG industry that followed, and both of those combined are 2 of our largest export industries, and combined with coal, that would be the top 3. Critical minerals now stands as the next chapter in the story of Western Australia's resources industry. Australia's resources sector reached record export earnings of $422 billion in 2021-22, and that's 70% of the total value of the exports of that country. Singapore is an important energy and trading hub for Australia's resources sector, and several Australian companies use Singapore as a regional base, including BHP, Rio Tinto and Fortescue Metals. The global move to net zero presents many opportunities for Singapore and Australia to work together and capitalise on the growth of new industries. The Singapore-Australia Green Economy Agreement was signed by respective trade ministers in October of last year, and implementation of this agreement will involve the active participation of businesses, investors, organisations and other stakeholders supporting both nations' economic transition to net zero. Last week, I addressed the Australian Parliament on the future of the resources sector, and I emphasised the crucial role that critical minerals will play. Critical minerals are destined to play a significant part in Singapore's ambitions to decarbonise as well. Critical minerals are going to be at the centre of not only climate mitigation, but also global security. We know that critical minerals, rare earth elements and energy transition metals are going to be vital in the future to support the manufacture of batteries, solar panels, electric vehicles and other high value products. That means the demand for lithium, cobalt, rare earths, platinum group elements, among others, will continue to grow. The International Energy Agency says that the world is on track to double its overall mineral requirements for clean energy technologies by 2040. Nations that can ensure a resilient and diverse supply of these materials will reap the benefits, and Australia is well positioned to be a partner of choice to support all of the countries in this region. Australia is, of course, fortunate to boast some of the richest deposits of critical mineral reserves in the world, as we saw in the previous presentation. We have the world's second largest deposits of lithium and cobalt and the sixth largest deposits of rare earths. But we can't develop these resources on our own. Foreign investment from partners will be crucial to getting Australian projects off the ground and establishing new and diverse global supply chains. Australia, of all nations, understands the need for increased foreign investment in our critical minerals and manufacturing sector to help get Australian projects off the ground. Australia's resources industry was founded thanks to foreign investment, and it will be those same foreign investors that help us build our critical minerals industry. With the trifecta of rich critical mineral deposits, an established and highly skilled resources sector, and high environmental, social and governance standards, Australia is an attractive partner for those wanting to develop new critical minerals and rare earth element supply chains. And we're doing a great deal of work to unlock the full potential of our critical mineral endowments. We are supporting sector growth through initiatives like the $2 billion Critical Minerals Facility and the $100 million Critical Minerals Development Program. An example of the support the government has provided, and this includes the former government, can be seen in the Iluka Resources Eneabba project in WA. When operated, this will be Australia's first fully integrated rare earth oxide refinery, and it's received approval for a $1.25 billion loan through the Australian government's Critical Minerals Facility, which is part of Export Finance Australia. Other critical minerals projects have found support from the government's Northern Australia Infrastructure Facility. Hastings Technology Metals secured a $140 million loan through the NAIF for its Yanjabana project. That's located in the Gascoyne region, again in my home state of WA, and contains NdPr resources. And of course, there is the support for Arafura Resources, who I know are here today, for their Nolans projects in the Northern Territory, which also secured NAIF funding as well as support from modern manufacturing grants and support from the EFA. These are three very important projects and projects the government will continue to have a great interest in and support. The Australian government is developing a new critical minerals strategy right now, and that will outline how Australia can grow the sector and move further along the value chain. It is going to explore the important role our critical minerals can play in helping Australia and international partners, including those in Southeast Asia, achieve their net zero targets. This strategy will complement work across government and industry policy like the National Battery Strategy and the National Reconstruction Fund, our ambitious emissions reduction targets and our foreign policy objectives. Broadly speaking, the National Reconstruction Fund has been designed to diversify and transform Australia's industry and economy. The government has earmarked $1 billion of that fund to invest in projects that add value in our resources sector, and in particular critical minerals and rare earths. In essence, it's about making sure a greater share of our raw materials are processed in Australia. For example, this fund could invest in mining science technologies that support the refining, processing and recycling of our resources into higher value products. I've highlighted our vast reserves, and others have highlighted as well, of high quality minerals and the fact that we are a world leader in the resources sector. And the NRF, the National Reconstruction Fund, will help us capture more value from these minerals resources, for example, in the manufacturing of batteries, but also in the precursor materials to those batteries. Our determination to get the settings right underscores how strongly we believe critical minerals and battery manufacturing can create economic opportunities across Australia and beyond. We would like Australia to become a partner of choice for Singapore and our Asian neighbours when it comes to critical and battery minerals. Our large critical minerals reserves, technical expertise and track record as a reliable and responsible supplier of resources and energy means that we can play a larger role in meeting global critical and battery mineral needs. The Indo-Pacific Economic Framework announced in May last year is one example of the way we are working closely with key strategic partners on critical minerals. An objective of this framework includes ensuring access to key raw and processed materials, semiconductors, critical minerals and clean energy technology. Australia and Singapore are both IPEF members, and this offers further opportunity to increase Australia and Singapore's cooperation on critical minerals and associated value chains. I would remind you, though, that we should not forget when discussing this theme of future-facing commodities, the role that traditional resources such as gas, iron ore, bauxite and coal will play as the world focuses on reducing emissions. Iron ore and coal are needed to produce the steel, which is essential for wind and solar generation. Each new megawatt of solar power requires between 35 to 45 tonnes of steel, and each new megawatt of offshore wind power also requires 120 to 180 tonnes of steel. And we need coal to make the steel. Gas, meanwhile, will provide the flexibility we need to add more renewables to the grid while being a vital feedstock and a heat source to process these critical minerals. The change in the air driven by the global commitment to net zero means new opportunities. Nations that are proactive, innovative and clever in the way they work with their strategic partners will be best placed to make the most of these remarkable opportunities. We are determined to be one of those countries, and we see nations like Singapore and others in Southeast Asia as playing a significant role. Ultimately, capturing more value from critical and battery minerals is going to build new industries, create high-paying jobs, and boost trade and investment across the region. It is an opportunity too good to miss, and we are looking forward to joining with you on this journey. Thank you all very much, and I wish you the very best to this conference. Thank you.
Thank you so much, Madeline. Thank you for making the journey over here. And as Madeline said at the start of her speech, there are a few stories more intriguing at the moment on the ASX in Australia than that Julimar deposit. It's got people talking, how the heck can such a big palladium nickel deposit be just sitting 70 k's from the mining sector headquarter in Perth, Western Australia? Alex Dorsch, you want to come up here and tell us about it, sir? So this fellow is the MD for Chalice. You've led the company through an exceptional growth period. And I was just thinking, when were you last here in Singapore? Were you here before pandemic 2019?
No, unfortunately not.
Wasn't? I was. And I remember what your share price was back there. Anyone else? 15 cents. What is it now?
That's $7.60.
And I'll sit
Yeah.
down now and let you keep speaking. Thank you. Would you please make Alex welcome, everyone?
Thank you very much for that kind introduction. Fantastic to be here at this event, and credit to the Federal Resources Minister for making the journey up to this part of the world as well. It's fantastic to see policymakers really, I guess, accelerating the push for critical minerals projects and growth of that industry. So Chalice, as it says here, our Julimar nickel copper PGE project is really a well-timed new large-scale discovery in Western Australia, and I'll take you through the history and some details on that project now. The usual forward-looking statements, these disclosures are available on our website or on the ASX platform if you wish to read these. So who is Chalice? Chalice Mining is an ASX 200 now globally recognised name in exploration. We have a team of a very sizable team of exploration geologists who have quite an incredible track record. We've got a very high performance results driven company culture, and our purpose, as it says there, is to really address the need for and the demand that's coming for these future facing commodities like nickel, copper, cobalt. And that is, you know, we really the challenge is actually finding the metal, not just building the mines. The mines actually build themselves largely. It's actually that the hard bit is actually finding the metal in the ground. So our aspiration, as it says there, is to, given what we've found in Julimar, is now to create a world-class multi-district green metals province in Western Australia. So here's our board of directors, some of our recent achievements, as it says there, about 4,000% return to shareholders since the discovery. So it's been a fantastic few years for Chalice shareholders. Our market cap today about 2.8 billion Australian dollars. We've got a well-financed company. We have just under $100 million at the end of last year. We've got some very serious institutional investors on our register now. So BlackRock mining fund in the UK, as well as predominantly a number of Middle East sovereign wealth officers and large US institutions. And we are starting to, I guess, capture the attention of the market in terms of research as well. Last week, we updated the market with some revised numbers for the Julimar resource. So as I says, this is a major new polymetallic critical minerals project in Western Australia. So what better place in the world to find a major new source of these metals? As you can see on the map on the right-hand side, the project is just outside of Perth, about an hour and 15 minutes drive. So quite unbelievable that it took until 2020 to recognise this. You would think that every day of the week, this would have been found in the 1960s, maybe the 1950s even. But we were fortunate to apply a completely new mineral systems approach to this area. And as you can see there, now we have a 560 million tonne resource at approximately 0.5% nickel equivalent. It is slightly unique in that it is a nickel sulfide or magmatic nickel sulfide deposit, but it's very rich in byproducts like palladium, cobalt, copper. As you can see, there's 16 million ounces of contained platinum group metals, 860,000 tonnes of nickel, 520,000 tonnes of copper, and 83,000 tonnes of cobalt. Makes it a very significant mineral system. But what's even more important here is that we have just, really sort of scratched the surface. We've got a 30-kilometre long newly recognised intrusive complex. So that resource number is going to continue to grow over the coming years. It also has some very high grade material within it. So the core of the system, as you can see, there's 120 million tonnes at almost 1% nickel equivalent. And that extends down to depths of 800 metres. We have actually already intersected mineralisation though down at 1100 metres and it's still wide open. So this is a strategic asset for Western Australia and indeed the nation. It's a very rare mix of commodities. Obviously, the PGEs are predominantly produced in South Africa and Russia. Australia has negligible current production, but the world is also very hungry for new sources of Class 1 nickel in particular. These are essential metals for decarbonisation and a range of technologies. We own 100% of the project, so we're really in the driver's seat. We've also got 8,000 square kilometres of surrounding tenure in a completely unexplored area. So this is a sort of once in a generation type of exploration opportunity. We have a sufficiently large resource there that we're progressing that to a development as quickly as we can. And we are just now launching a formal strategic partnering process, which I'll mention as well. And given the location here, it's safe to say that we have access to some of the best quality infrastructure anywhere in the world on the outskirts of a city of approximately 2 million people. So I mentioned that it's a strategic asset. You can see some of where these metals come from. Nickel and palladium is really a story in the case of nickel, Indonesia and the Philippines, but also Russia is one of the largest producers, particularly of Class 1 nickel, and Russia produces 40% almost of the world's palladium. So that is a very challenging situation for Western supply chains. You've heard the Federal Resources Minister speaking about the commitment that the Australian government has made to support projects like this. There's over $1 billion of taxpayer funds allocated to support projects like Julimar, and we're certainly getting lots of strategic interest from all players across the entire industry right now. These metals are critical. I don't need to mention this in too much detail, but safe to say nickel and cobalt are some of the higher profile metals at the moment used across a range of technologies, as you can see on the right there. I think platinum and palladium are probably some metals that aren't as well appreciated in terms of their green credentials. Palladium and platinum have been essentially doing the heavy lifting in terms of pollution mitigation over the course of the last 60 years. They've been used in catalytic converters, and they've really cleaned a lot of the major cities around the planet. Those are very critical metals because of how concentrated the supply is in places like South Africa and Russia. So to find a new large-scale deposit of PGMs outside of those countries is very significant. Speaking to the resource update we made last week, as you can see there, the new numbers contained 3 million tonnes of nickel equivalent within the resource. That's a growth of 50% from the numbers only 9 months ago. So you can see the value we're adding from very wide-spaced step-out drilling is adding a considerable amount of resource continually. Approximately 260 new drill holes were added to the resource. The resource is based on 1,000 drill holes, or approximately 280 kilometers of drilling. We've also, increased the open pit category resource, and that's predominantly been through drilling at the northern end of the deposit. We have actually been able to reduce the cutoff grade reported as well, just using some tweaks based on recent metallurgical test work. But really, we are still working on the flow sheet, so there is quite a lot of upside to the recoveries that we're seeing to date, and that work has not yet been incorporated into the economic constraints around the resource. We're also seeing that after a significant sized open pit resource, below that open pit resource, we have a growing underground category resource, and that, as I said, is wide open. So this is an image of the block model, the resource. It's contained within a singular 2 kilometer strike length conceptual open pit. The deepest resource block, as you can see there, is at about 800 meters below surface, but you can see the open arrows there. This is still a very much work in progress number. It is entirely on our own farmland as well. We've acquired about 23 square kilometers of farmland, so we own the freehold title as well as the mineral rights to the resource, and it's a very low strip ratio in that pit, which was predicted as well from the modelling. The high grade part of this system as well, as I said, 120 million tonnes within that global resource number, and that's where if you strip away blocks lower than 0.6% nickel equivalent, there's still about 10 million ounces of equivalent palladium in just the high grade part of this system. So this is, as you can see there as well, down the bottom left hand side, that's the 1100 meter deep drill hole that I mentioned, where at the base of that drill hole, we're intersecting 32 meters at 1% nickel equivalent, and that's about 600 meters beyond the block model. So as you can see, lots more work to do, and that this resource will continue to grow significantly. To put the current numbers in context, though, this is now already the second largest on a purely nickel basis. This is the second largest nickel resource or undeveloped nickel resource in Australia. But if you put it in equivalent nickel terms, so if you add all the byproduct credits together, it is now quite clearly the biggest undeveloped magmatic sulfide deposit in the country. And as you can see, we're in very good company there with Oz Minerals. Obviously now is under offer from BHP, so there is a high degree of appetite from all players in the sector right now to acquire assets like this. The deposit remains open down dip. This purple shape here, this is the host intrusion, the Gonville intrusion. This is approximately 500 to 600 meters true thickness, predominantly ultramafic unit, and it is effectively mineralized from top to bottom. So normally in the goldfields, you'd be fortunate if you saw sort of 3 to 10 meter wide ultramafic units. Very unusual to see something 500 plus meters thick. And as you can see there, we have approximately 1.6 kilometers of down plunge, down dip extent to continue drilling off before we, I guess, have actually constrained the resource and what we think is, according to 2D seismic, the intrusion does terminate there at a depth of about 1.5 kilometers. But there's actually no guarantee, and we haven't yet drilled that deep. So we're continuing to drill on the resource with 2 drill rigs and on very wide-spaced centres now. So those drill holes will add considerable tonnes in each of every one of those. But what's, I guess, most exciting here on this project is that about 6 to 10 kilometres north of the current resource, which is down the bottom of that map on the left-hand side there, you can see the outline of the pit shell and the outline of the Gonville intrusion there. As we go north along the strike length, we're getting indications of mineralization up to 10 kilometers further north. So what we've got here is a very significant magmatic system. Looks like, in terms of character, has a lot of similarities to the Norilsk-Talnak system in Russia, the Jinchuan system in China. So really, we are drilling along this complex to find where these pockets of high-grade mineralization exist along there. As you can see along that Hooley prospect there, we've had some fantastic recent results. So what we're intersecting up there is exactly the same geology, exactly the same mineralogy and mineralization there along approximately 5 kilometers of strike length, but that is itself open to the north as well. So we have 4 rigs drilling along the complex. We've applied for an additional permit to continue that work, and we expect to get that around about the middle of the year, at which point we'll scale up our exploration activities again considerably. So the belt in its entirety is not just 10 kilometers. I guess we know there's mineralization over at least 10 kilometers, but the belt, according to the geophysics and the soil sampling and the regional work we've done, we know it's a 30-kilometer stretch of mafic, ultramafic rocks. So these are sort of what dreams are made of for exploration geologists to be able to drill something like this for the first time. Everything north of the Dampier area there is completely undrilled thus far. So as I said, around the middle of this year, we will be increasing our exploration activities considerably and really testing those areas north there for the very first time. It's worth noting as well that a company that we're a strategic investor in, Caspian Resources, also have indications of mineralization up to 50 kilometers away from our resource. So this is a very large-scale mineral system, and one that is no doubt going to deliver something truly world-class. In terms of how we process this material, we have done a lot of work experimenting on potential flow sheets here over the course of the last 3 years, really since the discovery hole. We think that the obvious solution here is to produce a copper PGM concentrate. We're very fortunate that most of the PGMs float with the copper, and we can recover those and get very good payabilities from copper smelters selling products to them. And then we're looking at some hydrometallurgy options. We're looking at multiple different technologies in the midstream space to process the nickel cobalt into a mixed hydroxide precipitate. And that's a very attractive product for the battery industry and the precursor cathode active manufacturers. So we're looking into options on that side, and we're continuing to do test work. We also have a few things in relation to grind size, as well as potential leaching of flotation tails that we're also looking in. Really, the flotation tails leaching options are one of the more attractive looking options here, because we can really increase the PGM recoveries. So we are doing development studies. Those are very much underway, but we're also speaking to a range of potential strategic partners here for this asset to come alongside us. So really, it's a dual strategy for this project. We are in active discussions now with a range of strategic partners. We expect to close a transaction during this calendar year. We are advancing development studies really centered around the flow sheet and just confirming, I guess, the preferred flow sheet. And then towards the end of calendar year 23, we will be starting the regulatory approvals process. But worth noting that outside of Julimar, like I said, we have 8,000 square kilometers of unexplored tenure, and it is now, I guess, one of the most attractive projects in the world for new nickel sulfide discoveries. So as well as what we're doing on the technical side, obviously, we're working very closely with the community and the traditional owners at Julimar. We've got a very significant contribution already into local communities there, and we've committed to a no net loss biodiversity goal on the project. So that's going to be achieved through those 3 things mentioned there. Connectivity. We are looking to establish new biodiversity corridors, restore some areas that have been degraded, and then try and regenerate the soils for the purpose of carbon sequestration as well. So really, I guess, like I said, this Julimar discovery is much more significant than what the current resource that we've defined. If you look on the map there on the right-hand side, you can see all the nickel deposits that have been found there. The first one was found in approximately the mid-1960s. And since then, over the course of the approximately 60 years, there's been 25 million tons of nickel found in that area. And the difference here is that in 2020, the first one was found on the western side of the Yilgarn Craton, and we know that the edges of Archean cratons are the place to go exploring for giant magmatic systems. So as you can see, the orange areas there is Chalice, largely 100% owned tenure, approximately 8,000 square kilometers under license. We have a team of approximately 45 geologists that are combing over the entirety of that land package at the moment. And what we expect, I guess, is expect the unexpected. There is the potential here for a whole range of unrecognized geologies, like magmatic systems, mafic, ultramafic intrusive complexes, but also greenstone belts where we're keeping our eyes open for potential lithium bearing pegmatites. But what's clear in these systems is that to find them is actually very low cost. So we spent in the order of approximately 50,000 Australian dollars before drilling the discovery hole at Julimar. So we have hundreds of opportunities like that to find more and more Julimar-like systems across what is approximately 1,200 kilometers of the edge of the western edge of the Craton margin. And what we know is that Julimar as a mineral system is capable of delivering very high grade, the sulfide PGMs. So obviously the prize is finding more of that sort of material, and that is what's driving us in a very, very extensive regional exploration program that's ongoing at the moment. Just to wrap up, I think as I presented this to the PDAC in Toronto a few weeks ago, I think if you look at this chart of base metal discoveries, the 1960s, 1970s boom was quite phenomenal. And really, you know, since then, since the rise of China and the 11-fold increase in exploration expenditure over the last sort of 20 years, there's been a huge drop in exploration expenditure at the worst possible time. And since 2015, there's only been 7 giant base metal discoveries. If you look at the run rate back in the 1960s, 1970s, we were discovering 5, 6, even 10 of these giant systems per year. And now in the last 8 years, we've only found 7. So this is really the problem for the decarbonisation thematic, is that it really rests on, you know, actually exploring and finding the metal required. So to summarize, we have a world-class asset there in Julimar. This is a photo of the project on the right-hand side. We've got an exceptional team with a track record of making world-class discoveries. And we're very excited to continue to exploit the exploration upside in the new West Yilgarn province. So please come and have a chat at the booth if you'd like to learn more. Thank you.
Thanks very much, Alex. And I sort of want to get our teeth in right at the start.